Welcome to Sense Says, your daily dose of financial wisdom. Here on the Deep Dive, we unpack complex topics to give you the clearest picture. And today, we're diving into something almost every investor has wrestled with: market timing. Have you ever found yourself wondering if you should pull some money out or maybe hold on to new cash because you just feel a market dip is lurking around the corner? It's a primal financial impulse, really, especially when, the news cycle is full of economic uncertainty or stock prices seem to be scaling new heights.
Oh, it's absolutely universal.
Yeah.
And what's truly fascinating is the psychological game our own minds play on us. When that inevitable market dip does happen, maybe even months or years after we first had that feeling, our brains naturally go, see, I knew it.
Like you saw it coming all along.
Exactly. This selective memory or confirmation bias, it tricks us into believing we're these clairvoyant investors. And that just reinforces the urge to try and time the market again next time. It's kind of like recalling all the times you correctly predicted rain, and forgetting all the times you were wrong.
That makes sense.
So for this deep dive, we're going to try and put those powerful feelings aside for a bit and look squarely at what the hard data actually says. Is market timing really a viable, repeatable strategy for any investor?
That gut feeling you mentioned, it is so incredibly relatable. I mean, who hasn't stared at a lump sum of cash, maybe a bonus or an inheritance, and felt that knot of anxiety about investing it all at once, especially if headlines are screaming about record highs?
Absolutely. It's a very human reaction, this desire to protect your capital or to somehow optimize the entry point.
We all want to buy low, sell high, right? It just feels like the smart, intuitive thing to do.
It does feel intuitive. And look, it's not entirely without a kernel of truth. You see, there is data that suggests a relationship between where market valuations stand right now and what future returns tend to look like.
Okay, so there's something there.
Yeah, one of the more respected metrics for attempting to forecast those future returns is something called the Shiller XPE. That's the cyclically adjusted price-earnings ratio. Essentially, it's a long-term average of earnings designed to smooth out the short-term bumps and maybe give a clearer picture of whether the market is, historically speaking, expensive or cheap.
Okay, so we're not just talking about a hunch here. There's an actual data-driven metric that tries to link current market levels to what might happen next. And here's where it really starts to get interesting, or perhaps deceptively simple.
Yeah.
When researchers first looked at market history, it seemed to offer a really clear roadmap. Periods of high valuations, measured by something like that Shiller KE, have often been followed by lower returns over the next, say, decade.
Right, that's the initial observation.
And early findings from some really influential papers even seem to suggest an almost perfect relationship. Like if you had sorted stocks based on their valuation, the most expensive ones historically yielded substantially lower returns compared to the least expensive ones. On the surface, it almost looks like a perfect formula for market timing, doesn't it?
It really does. And that's precisely where the critical trap lies. The fundamental flaw in just looking at that historical data, as usually first appeared without proper adjustment, is what we call hindsight bias.
Hindsight bias, okay.
Yeah. Imagine you're trying to pick a winning horse. If you're sorting horses based on their performance after the race is run, using information you wouldn't have had when placing your bet, you're essentially cheating.
Right. You already know who won.
Exactly. A real investor, operating in real time, they can't know what future valuations will be. A stock that looks expensive today, relative to its past, might actually turn out to be quite cheap relative to its future earnings or growth.
So that proof isn't really proof for someone making decisions now.
Precisely. Any proof of market timing based on looking backward with perfect information is fundamentally flawed for real-world use. It's not just academic theory, it's a huge practical problem.
That's a critical distinction. So if we can't just sort stocks by their perfect historical valuation, like cheating, what happens when researchers adjust for that? What does it really mean for those initial, seemingly conclusive findings?
Well, researchers went back and basically put themselves in the shoes of a real investor. So they sorted stocks only using the past data that would have been available up to that specific point in time. No peeking ahead.
Okay, simulating the real world.
Yes, and the outcome? Well, the relationship between valuation and future returns, once adjusted for this real-world constraint, it became much, much weaker.
Not so clear-cut anymore.
not at all. It's still there, maybe a faint echo of a trend.
Mm-hmm.
Lower returns when stocks are most expensive, but it's nowhere near the obvious exploitable pattern it seemed to be with perfect foresight. It's like trying to navigate with a map where half the roads are just gone.
Okay.
And to complicate things even further, valuations aren't static. They can drift higher or lower for years, even decades.
Right, I don't just snap back to some average.
Exactly. And for reasons that aren't always clear or predictable. Think about the market's seemingly high valuations for much of the 1990s, or even more recently. This makes it incredibly difficult to confidently categorize the market as truly cheap or expensive in real time.
So if you can't reliably say it's expensive now,
How can you consistently profit from that label? It's not a simple buy at 10x earnings, sell at 20x game. It just doesn't work like that reliably.
so if relying on valuation alone is so tricky, what about just going with the flow? That brings us to another powerful market force, momentum.
Ah, yes, momentum.
This is that widely observed tendency for stocks that have been going up in price to, well, keep going up for a while. So when stocks look expensive, based on metrics like the Shiller KP, it's often because their prices have been on an upward trend, right?
That's often the case, yes. Price is the numerator in PE ratios.
So if you decide to sell them at that point, thinking they're too high, you're actually betting against this well-documented phenomenon of momentum.
You are. It's like trying to step in front of a moving train. It's a tough bet to win consistently. And this leads us to perhaps the most brutal, yet often overlooked, challenge of market timing.
Okay.
Most of the market's total returns actually come in a very, very small number of trading days. This isn't just theory, it's a statistical fact.
A small number of days drives most of the growth.
That's right. What's truly eye-opening here is if we look at data for, say, the S&P TSX Composite Index in Canada from 1977 through 2018. Over that long period, the index returned a healthy 9.72% annually on average. Pretty good.
Yeah, that's solid.
Now imagine you decided to pull out of the market for just a few days here and there, thinking you were being clever, avoiding a dip. If you missed just the single best trading day over that entire 41-year period, just one day, your annualized return would have dropped to 9.48%.
Wow, just from missing one day.
Yep, a small dip, but significant over time. But here's the kicker. If you missed the 15 best days, just 15 days out of literally thousands of trading days,
Okay.
your annualized return plummeted to a mere 7.44%.
That's a huge difference, over 2% less per year.
Massive. Simply for missing a tiny fraction, less than 0.2% of the total trading days. The crucial point here isn't about being lucky enough to somehow only miss the worst days, which is also timing, but that you simply have to stay invested consistently to capture the market's full long-term returns.
It's like trying to win a marathon by sitting out the fastest miles, like you said.
Exactly. You miss the crucial bursts.
That data really makes the task of being in and out of the market seem not just difficult, but, well, almost mathematically improbable for improving returns consistently. And it circles right back to that initial feeling of market uncertainty we talked about. I've had countless conversations with investors, and one constant I've observed is that the market always feels uncertain. There's just never a moment where everything is perfectly clear.
Never. There's always something to worry about.
Exactly. The economic winds are never all blowing in the same perfectly favorable direction. So using those feelings of uncertainty as a basis for market timing decisions, it just doesn't seem like a sound, repeatable strategy, no matter how strong that gut feeling might be.
It really isn't. Feelings aren't forecasts.
Now, acknowledging that fear, that real fear of investing at the worst possible time, many people turn to a popular strategy to soothe those nerves, especially when they have a lump sum of cash. It's called dollar cost averaging, or DCA.
Ah, DCA. Yes, very common.
This is where instead of dropping, say, $50,000 all at once into the market, you invest smaller, fixed amounts regularly over time, maybe $5,000 per month for 10 months, something like that.
Yep.
It really helps calm those fears of catching the absolute peak right before a crash. It sounds prudent, doesn't it? Feels safer.
It absolutely feels prudent. And look, it's systematic, which is great for building discipline. Can't knock that. However, if we connect this to the bigger picture we've been discussing, dollar cost averaging, while psychologically comforting, is ultimately still a form of market timing.
How so?
You are, by definition, deciding not to invest all your money immediately. You're choosing instead to wait, to spread it out, hoping later entry points might be better. That's a timing decision.
Okay, I see that. You're timing your entries over months instead of doing it all now.
Precisely. And statistically speaking, it's not designed to, on average, give you better results than investing that lump sum right away. In fact, a highly regarded study by Vanguard back in 2012 provocatively titled "Dollar Cost Averaging Just Means Taking Risk Later." They rigorously examined this exact concept across decades of market history.
Taking risk later. Okay, and what did that extensive study find across all those different market conditions and regions?
It's quite compelling, actually.
Yeah.
The study looked at stocks, bonds, balanced portfolios in the U.S. from 1926 to 2011, the U.K. from 76 to 2011, Australia from 84 to 2011, so long periods, different markets.
And the result?
The consistent finding was that lump sum investing actually beat dollar cost averaging roughly 2/3 of the time.
2/3 of the time, lump sum wins.
That's right. So while DCA provides that valuable psychological comfort, and that's not nothing, it often means leaving potential gains on the table simply because, on average, markets tend to go up over time. Delaying your market exposure often costs you.
So it's a trade-off. Comfort versus statistically likely higher return.
That's the heart of it. You know, a Nobel laureate in economics once famously observed that it is very difficult to imagine you can develop a true expertise in, say, predicting the stock market.
Why did he say that?
His reasoning: the world simply isn't regular or predictable enough for anyone to learn consistent rules that always work. There's just too much randomness, too many variables, too many unknown unknowns, as they say. The market isn't a machine. It's this complex, adaptive system driven by human behavior and countless unpredictable global events.
That's a powerful point. Market timing, then, it really is a double whammy of difficulty, isn't it? You not only have to get out at the right time, which, as we've seen, is incredibly hard, even with forecasting metrics.
Very hard.
But then you also have to nail the timing to get back in. And missing even a few of those critical high return days, as we saw with that S&P TSX data, can seriously damage your long-term return.
Absolutely. Getting out is only half the battle, and maybe the easier half, believe it or not. Getting back in is psychologically very tough, too.
And we haven't even really touched on the very real practical downsides,
Right.
like trading costs and taxes.
Oh yeah, those are the silent killers of returns, often ignored. Think about the cumulative effect. Maybe a small trading fee on every buy and sell, plus potentially significant capital gains taxes triggered by every profitable trade if it's in a taxable account.
Adds up quickly.
It really does. Over time, these costs can seriously erode any imagined profits from timing, making your net return far less than you might anticipate, even if you were somehow right about the direction. It's like trying to outrun a train while carrying a heavy backpack full of fees and taxes.
Yeah, that's a great analogy. It's why one of the most respected figures in investment history, Vanguard's legendary founder, John Bogle.
Jack Bogle, yeah.
He famously had this to say about market timing. After nearly 50 years in the business, I do not know of anybody who has done it successfully and consistently. And then he added, I don't even know of anybody who knows anybody who has done it successfully and consistently.
Wow. That's about as definitive as it gets, isn't it? From someone who lived and breathed markets for half a century.
Pretty much sums it up.
So, yeah, to kind of synthesize our deep dive here for you, the listener, while there is a theoretical relationship between market valuations and future returns,
That link exists.
it does, but that relationship simply isn't reliable or precise enough to serve as a practical guide for meaningful, consistent investment decisions. It's not a consistent crystal ball that you can actually act on profitably over time.
And that brings us right back to where we started, doesn't it? That feeling of nervousness when you're sitting on cash, waiting for some elusive, perfect moment to invest. And, well, okay, dollar cost averaging is statistically suboptimal compared to investing a lump sum immediately.
On average, yes.
It is still a far, far better option than just staying on the sidelines indefinitely in cash. Waiting for a perfectly clear, certain signal to invest usually just means waiting forever and missing out entirely on the growth the market inevitably delivers over the long run.
That's a critical point. Doing something systematic, even DCA, is usually better than doing nothing out of fear. And maybe this raises an important final question for you to consider. If even the most sophisticated data analysis and the longest stretches of market history don't consistently empower successful market timing, what does that really tell you about the true power of simply sticking to your long-term plan? Sticking to your plan versus chasing that seductive, yet so often elusive allure of making short-term predictions. Something to think about.